And inflation, I should say, swindles the bond investor too, and it swindles the person who keeps their cash under their mattress. It swindles almost everybody.
Inflation in the US is surging at the highest level in decades, reaching an annual rate of 8.5% last month, and prices have increased a total of 11.4% since the beginning of the pandemic. And despite inflation stealing purchasing power from consumers, the Federal Reserve, which does have a fix for inflation, up until now has pretty much done nothing about it. So it's important for investors to understand how inflation is a portfolio killer, because as Warren Buffett described at the Berkshire meeting, it swindles everyone, from bond investors to cash holders to stock market investors. In today's video, I'm going to be breaking down some clips from the latest Berkshire Hathaway annual meeting, where Buffett spoke about how stocks, for the most part, are unable to fight inflation, as well as a discussion around the unique type of businesses that do offer some protection against surging and accelerating inflation. Just before we get into today's video, I do want to give a quick shout out to today's sponsor, which is Sharesight, a portfolio tracking software that you can use to keep track of your stock portfolio gains, as well as track all kinds of things in regards to your performance of your portfolio, diversification, and when it comes to tax time. Sharesight allows you to automatically bring in all of your past trades by connecting your broker, or you can do it manually or using Excel. And once you do, you will be able to accurately track all of the different types of gains that your portfolio will experience, including currency gains, which most people are not accurately tracking. Sharesight gives you access to 12 different reports that can be used to track performance, as well as used when it comes to tax time. One of my favorites at the moment is the diversity report, which can of course be used to see how your portfolio breaks down in terms of different industries and sectors. But also for a value investor like myself, it allows me to get an insight into how much of my portfolio is concentrated in individual businesses. At the moment, you can try Sharesight for free and track up to 10 holdings for as long as you want. So if you haven't tried Sharesight, it's completely free. Go ahead and check it out. Also, if you want to sign up to a paid plan for more features, there's a starter, investor, and expert plan. And if you use my link, it's the first link in the description below, you will get 4 months off an annual subscription, which is a massive saving. But at the very least, go and check out the free plan and try it for as long as you want.
In the 70s, you wrote an article entitled "How Inflation Swindles the Equity Investor." You said that stocks cannot keep pace with inflation because companies cannot increase their return on equity. Do you believe that this is still the case?
During the meeting, Buffett got asked a question about an article that he wrote in 1977 for Fortune that was talking about how inflation swindles the equity investor. In the article, Buffett starts by talking about something that is pretty common knowledge, which is that bonds do very, very poorly during periods of high inflation. And this is pretty easy to understand for most people, because a bond, of course, has fixed income. So the coupon payments that you're receiving from that investment are fixed to the dollar, meaning as the purchasing power of your dollar goes down, as things get more expensive around you, the value relative to inflation of that bond is going down. But there's a misbelief that stocks, for the most part, can protect against inflation and are different from bonds. After all, a business's income isn't fixed, and theoretically, a business could increase their return on equity and therefore outpace inflation through something such as increased prices or reduced costs. However, in reality, the vast majority of businesses are unable to increase their return on equity, and as a result, when inflation increases, it essentially just erases real returns, and the business isn't actually able to produce any excess returns above inflation. In the article, Buffett uses an example of a business producing a 12% return on equity, and in this case, the business is paying out half of that of their earnings as a dividend, so let's say 6% of that, and 6% is being reinvested back into the business. If you think of a circumstance where inflation is at 6%, the dividend will be completely erased, and the 6% that is reinvested back into the business, that additional dollar being spent in the business will be spent on simply paying for the higher prices of replacement of capital and higher prices of inventory and those sorts of things. And as a result, even though the business is investing additional capital, inflation is erasing any real returns that the business produces. In the article, Buffett goes on to talk about 5 theoretical ways that businesses could attempt to increase their return on equity. And then he talks about how realistic some of these options are for businesses in a high inflation environment. The first way is that a business could increase their turnover, so increase their revenue or sales through, say, increased prices. Buffett believes that this is likely to have a minor impact, if any, and what's most likely to happen is that there will be an initial improvement in return on equity, but ultimately as assets need to be replaced in the business, they will need to be replaced at a higher cost, and that will ultimately result in a similar return on equity over time. Businesses could also try and find cheaper leverage in order to improve their return on equity, but in an environment where inflation is high, interest rates are also likely to be going up as the Fed attempts to tackle that inflation. So the chance that a business is going to be able to actually reduce their cost or their interest expense through cheaper leverage is pretty unlikely. Alternatively, businesses could attempt to take on more leverage, so change their capital allocation from being maybe weighted equally between equity and debt, and leaning more into debt, which is generally a cheaper form of capital. But at the time during this article, Buffett cited that corporate debt was already very high, and while of course this is back in the 70s, the same thing can be said today. There are some parallels between the amount of corporate debt that businesses had back then and have today. And the other thing to keep in mind is as interest rates go up, which is likely to happen in a high inflation environment, the effectiveness of using leverage relative to equity tends to go down. Possibility number 4 for businesses to improve their return on equity is through lower taxation. So taxes could go down, although this isn't actually something that a business itself can enforce. This would be up to the government at the time, and it's generally something that you would probably put in the category of important but unknowable. And then the last way is that businesses could attempt to lower their operating expenses relative to sales, but again, inflation is very likely going to be driving up prices for those expenses, so it's unlikely that businesses will be able to, in a high inflation environment, improve their operating margins. And he cited that from between 1965 to 1975, margins actually declined from 8.6 to 8%, even in nominal terms. So before even taking into account inflation, margins were worse during a high inflation environment.
And the problem, if you have a business that doesn't take any capital, and let's just say the dollar depreciates 90% or something, so things cost 10 times as much. If it doesn't take any capital, you can charge 10 times as much, and you've kept your relative position. But most businesses take some capital. If our utility business, just say that the dollar is worth 1/10 some years hence from now, we have to have 10 times the capital investment basically, and we get paid a return on that. But we have forced capital investment to essentially keep them in the same place.
So all of this sounds pretty negative. Buffett has a lot of discussion in that article as well as at the meeting about how inflation does swindle everyone, but he does also offer a way out. He talks briefly about ways that businesses and individuals as well can protect themselves in some way, either to some extent or entirely against inflation. The way that some businesses can do this is if they can increase their prices without the need for additional capital. And that's just another way that Warren Buffett is describing the effect of having a unique competitive advantage, some kind of wide economic moat, something unique that customers love that allows the business to raise their prices without seeing really a reciprocation of lower sales and without actually having to invest any additional capital, without actually having to improve the product at all. They can just raise prices and customers are willing to pay those higher prices relative to competition. And the way to think about economic moats is something that allows a business to consistently over time produce excess profitability. So something that allows a business to be more profitable than other businesses around them, competing against them, and that there's some kind of barrier preventing competition from eating into that additional profitability. And there's a great book called 7 Powers by Hamilton Helmer, which goes into some of the key ways that businesses can build some kind of long-term competitive advantage. And while I've spoken about some of these in a previous video, there was one type of advantage in this book that I haven't spoken about before, so I'm going to break it down for you in today's video. But in the book, he's essentially describing businesses that have augmented cash flow, so abnormally high cash flows, and they're able to do that through either increasing their prices or lowering their costs, or a combination of both of them, and that they're able to have some kind of barrier preventing other businesses from also coming and stealing that additional profitability over time. And Buffett in the Berkshire meeting actually alludes to this idea as well.
The best thing you can do is to be exceptionally good at something. If you're the best doctor in town, if you're the best lawyer in town, if you're the best whatever it may be, no matter whether people are paying you with $1 zillion or paying you, they're going to give you some of what they produce in exchange for what you deliver. And if you've got it, and if you're the one they pick out to do any particular activity, sing or play baseball or be their lawyer, whatever it may be, whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. Somebody else will give you some of the wheat they produce or the cotton or whatever it may be, and they will trade you for the skill you have.
While Buffett here is talking about an individual and how an individual could protect their income during inflation, the same thing applies to businesses. And one way that businesses over time have developed an advantage, a sustainable advantage, is by doing something called counter-positioning. Counter-positioning occurs when a new business adopts a superior business model while existing legacy businesses do not copy it because it would damage their existing revenue streams. And this difficult situation is exactly why the legacy media companies have been so slow to roll out streaming, even though it has been extremely successful for Netflix, and it is clearly a superior and much better way for consumers to consume entertainment content. And the best situation for Netflix in adopting and developing this kind of advantage is where the new business model, the new superior business model, is attractive on its own. So in a standalone way for Netflix, is that business model attractive? But it's actually less profitable than the inferior way that legacy media businesses are providing content. In that circumstance, the business model will be great for Netflix, but legacy media businesses will be slow to transition, because as they do transition and as their customers change from consuming content through cable and to consuming content through streaming, they will be cannibalizing their existing businesses and may end up actually being less profitable than they were previously. For legacy media companies like Warner and Disney, they'll be cannibalizing their cable subscription and advertising revenues for, in some cases, smaller streaming revenue streams. And even if streaming is more profitable than these legacy models, these legacy businesses will still tend to be extremely slow in moving over due to a number of cognitive biases, such as believing that there's added uncertainty, or not believing, but just the fact that there is added uncertainty around this new business model and whether it will work. And also just the misbelief that the old inferior way of consuming content will still be around at some point over the very long term. And then if a counter-positioning advantage is combined with something such as scale economies or scale economies shared that is benefited from the first mover advantage from the business that's taking the counter position first out of all of the other competition, it can be an incredibly difficult business to erode over time. In Netflix's case, they are the only business that has reached enough subscribers and are charging enough per subscriber to actually be profitable in streaming. So not only will the legacy media businesses be cannibalizing and damaging their old revenue streams as they invest more money and transition their customers over to streaming, they'll still likely have to operate their streaming platform unprofitably for some time in order to reach scale in which they can operate profitably, if they can even reach that position at all. But as Buffett explains in that article, even businesses with deep competitive advantages may not be able to increase prices far enough to outpace their increased costs in a high inflation environment, which is why his ultimate conclusion is that high inflation or persistent inflation across time is very, very bad for equity investors. If you want to learn more about economic moats or inflation, I have a number of videos covering both of these topics, and I'll leave a couple of links down in the description below. But I hope you guys enjoyed today's video, and I'll see you in the next one.